Welcome to Day 22 of Future Business School's Daily MBA series. Today, we're diving into a vital topic for both businesses and investors: risk management and hedging. We'll explore the different types of risks businesses face and how tools like futures, options, and other derivatives can help manage and mitigate those risks. Effective risk management is crucial for any business looking to thrive in an unpredictable environment, whether it's protecting against currency fluctuations, price volatility, or interest rate changes. Let's get started. What is risk management? Risk management is the process of identifying, assessing, and taking steps to reduce or eliminate the risks that businesses face. Every business faces uncertainty, and managing that uncertainty is essential for long-term success. Types of risks. Market risk. The risk of financial losses due to movements in market prices, such as stocks, commodities, or interest rates. Credit risk. The risk that a borrower will default on their obligations, leading to financial loss. Operational risk. The risk of losses from failed internal processes, systems, or external events like natural disasters. Liquidity risk. The risk that a company won't be able to meet its short-term financial obligations due to a lack of liquid assets. Currency risk, also known as exchange rate risk. This is the risk that changes in foreign exchange rates will affect the value of a company's assets, liabilities, or income. Commodity risk. The risk of losses due to fluctuations in the price of raw materials, such as oil, gas, or metals. Managing these risks requires a structured approach. A business must identify which risks they face, measure their potential impact, and implement strategies to mitigate them. One common method for managing financial risk is hedging, which involves using financial instruments like derivatives to offset potential losses. What is hedging? Well, hedging is the practice of reducing or eliminating risk by taking an offsetting position in a related security, commodity, or financial instrument. It's kind of like buying insurance for your investments or business activities. While hedging doesn't eliminate risk completely, it can limit the impact of unfavorable price movements, interest rate changes, or currency fluctuations. Key hedging instruments include futures, options, and derivatives. Let's break each of these down. Step 1. Futures contracts. A futures contract is a legal agreement to buy or sell a specific quantity of an asset at a predetermined price at a future date. Futures are commonly used to hedge against price changes in commodities like oil, wheat, or metals, but they're also used for financial instruments such as currencies and interest rates. Example: suppose you're a wheat farmer and you expect the price of wheat to fall before your harvest. You can sell wheat futures to lock in today's price, ensuring that you won't lose money if prices drop. Conversely, if you're a bread manufacturer worried about rising wheat prices, you can buy wheat futures to lock in your costs. Futures are widely used in industries that deal with price volatility, such as agriculture, energy, and finance. Real-world example: airlines and oil futures. Airlines frequently use oil futures to hedge against rising fuel costs. By locking in fuel prices ahead of time, they can stabilize their costs and protect themselves from price spikes that could harm profitability. Step 2. Options contracts. An option is a financial derivative that gives the buyer the right but not the obligation to buy, called a call option or sell, known as a put option, an asset at a predetermined price before a specified date. Options are more flexible than futures because they provide the right, but not the obligation, to execute the trade. Let's say you're a company that imports goods from Europe, and you're worried the euro will strengthen against your local currency. You can buy a call option on the euro, giving you the right to buy euros at today's exchange rate, even if the currency strengthens in the future. Types of options. A call option is the right to buy an asset at a set price. A put option is the right to sell an asset at a set price. Options are widely used in the financial markets to hedge against currency, interest rate, and stock market fluctuations. For a real-world example, tech companies like Apple and Google often use stock options as part of their employee compensation packages. Employees are given the option to buy shares at a set price, and they can exercise these options if the company's stock rises, helping the company retain talented workers. Step 3. Derivatives. Derivatives are financial contracts whose value is derived from an underlying asset, index, or interest rate. Futures and options are both types of derivatives, but other complex derivatives exist, such as swaps and forwards. Types of derivatives. Swaps are contracts in which two parties exchange cash flows or financial instruments, often used to manage interest rate or currency risk. Forwards are like futures, but they are private agreements and not traded on an exchange. They're commonly used for hedging currency or interest rate risks. Derivatives are used by businesses to hedge against price changes, currency risk, and interest rate fluctuations. However, because they can be complex and highly leveraged, they also come with significant risk if not properly managed. For instance, banks like JP Morgan use derivatives to hedge risks in their massive portfolios. They might use interest rate swaps to manage exposure to fluctuating interest rates on loans they have issued. These tools allow the bank to stabilize returns while minimizing risk. Case study risk management at Coca-Cola. Let's look at how Coca-Cola manages risk, specifically currency risk. Coca-Cola operates in over 200 countries, so they are highly exposed to fluctuations in foreign exchange rates. To protect themselves from currency risk, they use a variety of hedging strategies, including currency futures, to lock in favorable exchange rates for future transactions. They also use options to protect against adverse currency movements without fully committing to a trade, and swaps to exchange future cash flows in one currency for another. By using these tools, Coca-Cola ensures that fluctuations in currency rates don't significantly impact their profits. This allows them to focus on their core business of selling beverages worldwide. Conclusion and key takeaways. Effective risk management is essential for protecting a business from unexpected losses. Using hedging instruments like futures, options, and derivatives, businesses can protect themselves from market risks, currency fluctuations, and commodity price changes. Key takeaways. Futures help businesses lock in prices for assets like commodities or currencies, reducing uncertainty about future costs or revenues. Options provide flexibility by allowing businesses to hedge against unfavorable movements without fully committing to a trade. Derivatives like swaps and forwards help manage complex risks such as interest rate changes or foreign exchange exposure. Thanks for watching today's episode on risk management and hedging. If you found this video useful, please like, share, and subscribe to Future Business School for more daily insights. In our next session, we'll dive into business ethics and corporate governance. See you then.